We've come across a handful of really cool trophy assets on the show, but most of the time, the associated business is barely even profitable.
We saw that with Manchester United and Madison Square Garden Sports, and yet you're telling me that there is an event that occurs once a year that is an exception to this rule.
That's exactly what I'm saying. Behind the famous Kentucky Derby race in all its pageantry, which attracts something like 5 times the number of attendees as the Super Bowl over the course of a week, is a gambling empire owned by Churchill Downs Incorporated. And the company is, well, a trophy asset holder and profitable compounder.
Today, we are off to the races, and no, it's not because we are covering Ferrari once again, it's because Shawn is pitching Churchill Downs, ticker CHDN. And this is, at its core, a gambling company, you might say, which may immediately rub some listeners the wrong way, but at the same time, you could argue it is equally as much a hospitality and even an events business. The company's crown jewel is the beloved Kentucky Derby horse race bonanza that, as a German, I had somehow never heard of before until Shawn made me aware of just how wildly popular the 2 minute race and associated festivities are in the US. And as far as I understand it, not unlike Formula One races or the Super Bowl, the Kentucky Derby is more of a cultural event and a party for the wealthy than it is simply a sporting event. But before I let you take it from here, Shawn, I should mention that nothing on this show, as always, is meant to be taken as financial advice, and it's only meant for educational and entertainment purposes. And I should also mention that we are welcoming our fourth cohort of members into the Intrinsic Value community, which is a special group of investors we have cultivated over the last year. And the intention is that every member must pass an application and an interview process led by either Shawn or me. And then, if approved, that unlocks access to an exclusive group of sophisticated investors with discussions forums for stock ideas and weekly virtual calls with other members to discuss investing topics or to listen to expert guest speakers like Adam Cecil and William Green. Membership in the community also gives you access to private dinners hosted by the Investors Podcast in Omaha for Berkshire Weekend, as well as events in New York City next fall. All right, and with that, Shawn, tell us about your pitch today.
When I picture the Kentucky Derby, a few iconic images come to mind: extravagant hats, mint juleps, pastel colored preppy clothes, and then the thunder of hooves during the most exciting 2 minutes in sports, as they say. And it's really it's a spectacle of tradition and Southern charm, and an event that I think you could really say has been a fixture of American culture since all the way back to 1875, even if you've never heard of it, Daniel. And the company behind this legendary race is Churchill Downs, as you mentioned. And I think many folks will immediately recognize that name just for being synonymous with the name of the famous racetrack itself, where the Derby is hosted. And behind the pageantry of Derby Day, though, lies what I've actually found to be a pretty complex and fascinating business, honestly. And so in the past, when we've covered public stocks that are driven by sporting events like Madison Square Garden Sports with the Knicks and Rangers or Manchester United, the conclusion was always that, okay, these are really not very good businesses to own, even if they are kind of nice trophy assets to have. And it's kind of fun to say you own them. These are not highly profitable operating businesses. Whereas with Churchill Downs, the company, because it really is at the center of this massive horse race betting ecosystem, and then due to all the week-long festivities and the media contracts associated with the Kentucky Derby, it is actually a legitimately more viable business that can consistently be profitable. And that helps explain how over the last decade, shares in CHDN have compounded at 17% a year. And even though Churchill Downs is synonymous with the Kentucky Derby and therefore the greatest 2 minutes in sports, as I've said, it's how they make the most of those other, and I did the math here, 525,598 minutes in a year that really matter, and how they cultivate those 2 minutes of excitement into a full year of gambling and celebration and hospitality. That is really the investment story here. And so the three pillars of what I think we'll cover today is, ranging from talking about how the house does in a gambling sense, with that being Churchill Downs, and then also the horse and horse racing component, and then also how regulators factor in. And all three things are pretty closely intertwined, I'd say.
It's funny because oftentimes we joke here in Europe that sports in America are just a way more of an entertainment product and a money making machine than actual sports. And I kind of get the feeling that this company might be at the forefront of this. My understanding here, as you said, is that the iconic Churchill Downs racetrack and the Derby is just the tip of an iceberg that includes what is really a sprawling network of casinos and cutting edge wagering technology too, with some really unique moves over the years to kind of reposition the business, whether that be in moving toward a B2B supplier of IP and data to gambling companies like DraftKings, or in just, let's call it, creative financial engineering.
So one example of the latter with the creative financial engineering is that in 2002, under Tom Meeker, who ran the company for 22 years, Churchill Downs Incorporated transferred the title of the Churchill Downs racetrack facility to the city of Louisville, Kentucky. And that was not a sale in the traditional sense. The deal was part of this financing arrangement to fund a transformation of the entire facility, basically. And in exchange for the rights to the Churchill Downs racetrack, the company entered into a 30-year lease with the city instead of owning the track outright, which had this benefit of saving them millions in annual property taxes. And so I think, in other words, the city of Louisville knew it would benefit from the $100 million plus investment in tourism and gambling that was being made here. So they agreed to essentially help out and legally take ownership of the racetrack in this temporary way to remove the required property taxes, contingent upon Churchill Downs then agreeing to donate a portion of those property tax savings back to upgrading local schools, with the most crucial detail from an investment perspective being that shareholders have a buyback clause, which effectively means Churchill Downs, the company, can reacquire the entire Churchill Downs facility at any time for just $1. But the reason they don't do that is because they would have to start paying property taxes again. So to me, it does all look pretty savvy. They retained ultimate control of the racetrack while sidestepping property taxes with the city's blessing without actually sacrificing the company's crown jewel. I mean, that's good stuff.
It sounds like a pretty smart move to me, if you ask me. I mean, I don't know if anything like this has ever happened in football, but from my research on Manchester United, I did gain some insight into the politics behind owning huge stadiums. And I did get the feeling that cities know the value of course, tourism and just global branding coming through the clubs and also the stadiums. So there are often at least some kind of deals between cities and clubs, although having to pay no property tax at all is pretty something for the Kentucky Derby, which is just I have never seen in any other sport or for any other club. So while the Kentucky Derby is the company's flagship event and just a massive cultural touchstone, as I now know, I think it's fair to say that its financial stability is coming from another part of the business, which is casino gaming, and specifically a unique type of device called a historical racing machine, or in short, HRM. And this was all new to me before you gave me a rundown of the pitch, but HRMs are gaming terminals that look, sound, and feel almost identical to traditional slot machines. But the key legal difference is that their outcomes are based on the results of thousands of previously run anonymous horse races. This allows them to just operate under pari-mutuel wagering laws, making them legal in states like Kentucky, where traditional slot machines or casinos are prohibited. And assuming that's right, I think it's a pretty subtle loophole. But from my understanding, horse racing and gambling are such a large part of Kentucky's economy. It's just hard to imagine anyone seriously wanting to close that loophole. And you were telling me that in 2022 alone, horse racing related groups spent more than $800,000 lobbying state legislators in Kentucky. So clearly there are pretty entrenched and powerful corporate interests molding what's allowed and not allowed in the state. And from an investor's perspective, even if it is a bit complicated morally, you can have some degree of confidence in knowing that the legal tides aren't likely to imminently turn against you. And, at least not in a state as important to horse racing as Kentucky.
I think you're right. And the scale of the business here is just staggering. I mean, according to industry reports, Kentucky's horse racing machine business generated over $9.6 billion in handle in 2024. And handle is just gambling parlance for basically the total amount wagered during that year. And so that powerful year-round revenue source with very high margins, I should say, stemming from thousands of these machines provides the cash flow to support the capital intensive and seasonal, but also world famous event that is the Kentucky Derby. And if we think of the Derby as the brand anchor, it's this HRM gaming that is the workhorse funding most of the returns to shareholders. And as listeners today, whenever you hear us say HRM, as you said, Daniel, just picture a slot machine for betting on anonymized horse racing results from the past. So that's all it is. But we'll be saying HRM a lot. So it's just a heads up for something to look out for. And really, the key political question is whether Kentucky just wakes up one day and decides to tax these machines like normal casinos. And that could wipe up to 10 percentage points off their operating margins. And there are certainly groups pushing for that. But so far, the coalition of tracks and breeders and the broader horse industry has just been extremely effective in framing historical horse racing as actually being part of agricultural and rural economic development, since the proceeds are partially being reinvested back into these communities and into raising horses. And legislators go to the Derby, they see the jobs and the tourism, and they've repeatedly stepped in to protect the status quo. And so this does not mean that the tax risk is totally eliminated, but I think it does mean you're betting against a pretty entrenched local constituency if you were to expect a giant sudden tax hike or change in the status of how these machines are taxed.
So I alluded to this earlier, but given how central gambling is to the business and the massive audience reach of the Derby itself, Churchill Downs has made some moves that might seem surprising to many, at least at first glance. And one of them is that instead of continuing to compete primarily in an industry where competitors are spending hundreds of millions, if not billions, on marketing and promotions to acquire customers, the company announced it was at least partially exiting the world of direct to consumer online sports in 2022 and then shifting the focus to B2B. And this has meant providing its horse racing content and the technology platform from its Twinspires brand to other sports books, basically allowing companies like FanDuel to offer horse race wagering to their massive pre existing customer base, with Churchill Downs then taking a cut from that. Is that how it works?
It is, and it was a pragmatic move. They saw a gold rush in mobile sports betting that others were willing to invest everything in chasing, whereas Churchill Downs needed to sustain its business. And so they sort of opted to be a middleman in this regard. And that has actually come with high margins. Churchill Downs definitely does act like the house in many cases. I mean, don't get me wrong, they facilitate consumer gambling themselves, but they gave up on being a diversified sports book, you might say, to remain focused on their horse racing niche. And as such, they've opted, as the metaphor goes, to sell shovels during a gold rush rather than participating in the gold rush itself. And so, as I actually have a quote here from Churchill Downs executives, he said, "We will get a piece, a marginal piece of every single track that goes through the platform, regardless of whether we own that track or not." And I take that as, they sidestepped the immense marketing cost of the sports betting wars and profit now from the entire industry's overall growth by becoming a technology and content supplier to the ecosystem.
I mean, I'm definitely not an expert on the gambling sector, but when I sometimes hear about the marketing spend and the budgets that these companies have, and I compare that to, in my opinion, the non-existent mode that most of these businesses have, I think it can be a pretty smart decision and move to just take a step back, miss out perhaps on a couple of percentage points in margin, but then in return benefit no matter what casino or game ends up winning. And I still want to look a bit more at the regulatory side of things because, well, how could you talk about a gambling stock without at least understanding all the legal implications? So, yeah, how do you think about it? What's your take on it? Is it the main risk about the company? How do you see that?
The world of gambling is governed by a patchwork of state and local regulations. And that has led to some really bizarre business requirements. And so a perfect example of that is at the company's Calder property in Miami Gardens, Florida. And so for years, in order to operate a casino with slot machines legally, Calder was required by Florida law to also hold a permit and conduct live highlight performances. Yes, I said live highlight. And for those who are not familiar, highlight is a sport involving bouncing a ball off a walled court. And obviously it has nothing in common with a modern casino. There's also a famous beer, I think, that is called highlight. But the legal framework, for whatever reason, has tied the two things together such that if the company wanted to run the casino, it has to also host the sport. So that is just one example of the many, many strange things I've seen in this world of business and gambling and local regulation. And that was not an isolated incident. I mean, navigating these regulatory mazes is sort of a core competency for gaming companies that almost creates a barrier to entry for competitors. And it was only in 2021 that a new law decoupled the activities, meaning the Calder property no longer has to host highlight tournaments to run its casino. But yeah, I mean, I don't think you'll find more elaborate and puzzling legal loopholes being threaded by publicly traded companies to the same extent in almost any other industry, really. And some of the regulations work in their favor. Under Kentucky's rules, each horse racing track gets to have a facility and is permitted one annex gaming hall. And that annex has to sit within 60 miles of the track, but then outside the 60-mile protection zone of other racetracks. And what that does is give Churchill and these other license holders sort of de facto local monopolies for slot machine like horse race gaming in their home regions. And since these other licensed competitors cannot encroach too closely on them.
So know that Churchill Downs once owned Big Fish Games, which is a mobile gaming subsidiary with an apparently free-to-play app called Big Fish Casino that they acquired, I think, back in 2014. And this was a pretty significant effort for them to diversify. Mobile gaming is a big step from the Kentucky Derby. And so while the game was free to download, players obviously could purchase virtual chips with real money to continue playing. And that freemium model led to a massive legal challenge because of the gambling aspect involved, obviously. And what should we make of this whole endeavor? And what does it say about the general opportunity to diversify and get into other businesses in gambling companies in general?
It was a learning lesson for sure. And regulars do not want to see gambling businesses expand too far into other areas. So they are kind of forced to stay focused on their niche, even if from a diversification perspective, they would probably love to have different types of revenue streams with maybe much less legal ambiguity attached to them. And I'm sure that's what they're hoping for with this Big Fish casino game acquisition. But as you said, a pair of class action lawsuits allege that the sale of these virtual chips in the game constituted illegal gambling under the state of Washington's law. And so the plaintiffs argued that because the chips were required to play the games, they were a thing of value, making these transactions unregulated wagers, technically. And so the outcome was very painful for the company. The lawsuits were ultimately settled for a pre-tax total of $124 million, which is extra tough to stomach because Churchill Downs actually had already sold the Big Fish Game subsidiary at that point. But under the terms of the sale, they had agreed to indemnify the new owners for losses from this specific litigation. So Churchill Downs was still very much on the hook for this settlement. And that whole escapade ended up going much worse than they probably ever anticipated. And that is the risk to this industry, especially when you go beyond your core focus. There's asymmetry to the downside due to the fact that the regulatory environment can change on a whim. And then suddenly they're found to be doing something illegal and on the hook for that financially.
Speaking of changing on a whim, as far as I know, sports betting wasn't even legal in the US at a federal level until 2018, so not that long ago. And that was when the Supreme Court struck down a prior law and then opened the door for states to set their own laws around sports betting. And so there have been various loopholes and exemptions for horse racing over the years, but let's talk about the actual derby itself now because, that's how we teased this episode and we haven't even talked about it for a while now. So this is an event that at its peak comfortably puts more than 20 million TV viewers and is more popular than most NFL games, which is really no small feat, especially in the US, since if you look at the rankings of top television broadcasts in the US every single year, a huge number of them are either college football or NFL games. And for context, last year, the Derby's viewership ranked above Game 7 of the NBA Finals, the final round of the Masters Golf Tournament, the Indy 500 race, the Daytona 500, and the Formula One Miami Grand Prix. So I don't know, it's kind of funny to think about this once a year event in a sport that otherwise that does not have mainstream popularity at all. At least I think so, at least not here in Germany. And still, it's such a pillar of a publicly traded company. But that is the reality, for better or worse. And where other parts of the business are truly about gambling, the Derby itself is as much a spectacle of just hospitality and sporting as anything, right?
I've had some friends go to the Kentucky Derby, and it is the type of thing where I forget about it even existing, and then suddenly for like 2 days before, I'm gripped by all the different narratives and the fun of trying to pick the winner, and then at the same time, it somehow seems like half the people you know on Instagram have all gone to the event, and that's when I remember, wow, yeah, this is a big deal, and clearly it is much more than an actual race, and for Derby week, Louisville actually turns into a week-long festival. The largest fireworks display in North America happens over the river there. There's hot air balloons at sunrise, cooking competitions. There's actually a marathon, bourbon everywhere, of course, a museum that's actually even still packed in the off season, devoted to the history of the event. And then that 2 minutes of racing that you said pulls NFL level TV ratings. And so then on TV, ESPN and all these other networks love to talk about the history of the Derby, follow around the horses and riders, and all that stuff just feeds into the hype for people who are watching casually from a distance.
I actually lived very close to a Derby racing track my entire childhood. I mean, there were no hot air balloons and there was no huge fireworks ever going on, but I only went to a race, I think, once or twice in my entire life. And it's definitely not a big thing here in Germany, but I know that my granddad, who is from England, is a huge fan and he has, photos of horses on the wall. So I know it's a big thing over there. And who knows? I mean, maybe my next trip to the States, besides going with you to Omaha for Berkshire weekend, obviously, should be the Kentucky Derby because I think it really does sound like a ton of fun, and I could definitely see myself going there. As you know, my co host Shawn and I are obsessed with analyzing companies. But you probably have noticed from personal experience that talking stocks is not everyone's favorite hobby. And I'm reminded of that every time I bring up investing at dinner or when I'm out with friends. They tolerate it for about 10 minutes, but then I get this look. The one that says, we get it, you love stocks, but this is not the place. So Shawn and I thought, why not build that place? And we did it. It's called the Intrinsic Value Community. Our members range from pilots and firefighters to lawyers and engineers, but also hedge fund managers, actual rocket scientists, and CEOs. And despite those different backgrounds, what connects all of us is the passion for value investing and continuous learning. And each week we host live calls covering everything from vetting the group's best stock pitches to analyzing portfolios, investing case studies, and conversations with expert guest speakers who are either prominent portfolio managers, CEOs, or authors. And the best thing is that if you ever miss a call, we have a library of recordings for watching back every single call we've ever hosted. And if you prefer reading over watching, well, then we have dedicated spaces in the community to share write-ups, discuss investing ideas, or just your thoughts on the general market. And multiple times a year, we bring the community from the virtual world into the real one, including private dinners in Omaha for Berkshire weekend and meetups in New York City to explore, hang out, and most importantly, talk stocks. Our last cohort of members brought together 20 incredibly thoughtful people, some of the sharpest investors that Shawn and I have ever met. And if you want the chance to learn alongside people like that, you should join our waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community.
Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. Yeah, there you go. Well, listeners, tell us if we should all meet up at the Kentucky Derby next year. But yeah, I mean, just going back to talking about the festivities that occur over the course of the week. I mean, they attract something like 370,000 visitors, which management loves to highlight that if you think about that in terms of Super Bowl attendance, that is about 5 Super Bowls worth of people. And so you've also got the Race for the Crown series on Netflix, and nearly 300 million social media impressions across Facebook, TikTok, Instagram, YouTube, and so on. And so viewership on TV is actually not falling off either. The Kentucky Derby's reach has only been growing over the years. And in terms of how the Derby week revenue breaks down, about 60% comes simply just from ticketing for the event, with about a fifth of revenues coming from wagers placed during the week. 15% or so of total revenues from the week are brought in from sponsorships and licensing, and the remaining revenue comes from things like broadcast rights. And if you just look up the cost to book a suite at the Derby, I mean, it is eye-opening. You were talking about having to sign a multi-year lease commitment that can cost anywhere from $130,000 to over $250,000. So you can see how ticketing is such a big driver of revenues when you are literally focusing on the ultra rich and large corporations as your clientele who are buying these suites almost certainly as a way to signal status and prestige exclusively. I'm guessing a lot of these people do not care that much about horse racing, yet $200,000 in a suite is something that they will not even blink about. So yeah, I mean, even just for a private room, not a full suite, the cost can be as much as $1,800 per person. And then when I checked the site, the ticket costs for general admission and standing room for 2026 can range from $165 a person just to stand in the infield with no view of the race to $2,800 a person if you want reserve seating. And then I'm sure those prices can rise significantly as you get closer to the event. So obviously, I'm looking at these a number of months out from when it will actually happen. And so at the lower end of that pricing spectrum, you actually get this funnel of college kids and folks in their 20s that just like to dress up and say they were there, get a picture for Instagram, all that kind of stuff. But then these younger attendees do end up funneling into the higher ticket packages as they age, move up the corporate ladder, move up in income status, and then they want to come back and say that they actually watched it from a suite and participated more in the festivities other than just drinking in the infield.
I'm sure it's fun, but hearing about those prices, what do you say about just sticking with Omaha? I think that's pretty fun as well. No, but it's really interesting just how much money is made through ticket sales and how little is coming from actual broadcasting rights. I mean, when you look at football clubs or almost any other sport, you see the total reverse. Despite 70,000 people in the stadium each week, most of the money is earned from broadcasting. But obviously, it's a bit harder to monetize peak viewership that only lasts for about 2 minutes, maybe five if people are not fast enough to turn off. But from the financial reporting, they actually grouped together live events with the historical horse racing machines, which is a little tangled, but combined the two things reflect about half of the company's entire revenue. So we're definitely not overstating the importance of the Derby to Churchill Downs as a company. And the two are interlinked. Without the hype of the Derby, I'm sure you wouldn't have anywhere near the same interest in playing games based on historical horse races. But yeah, I would like to look more at the business of betting. You hear these expressions that the house always wins, and I'm not sure it does, but I would be curious to hear to what extent you think that's true and how the profit margins can vary across the gambling industry generally. I'm sure some casinos are more profitable than others, but even then, I would wonder if more mature casinos with longer operating histories tend to be more profitable, for example, or if bets on live horse racing are the same or more or less profitable than historical racing machines?
So they're all good questions. I'm not surprised coming from you, Daniel. But I mean, if we go back to 2018, when Churchill Downs sold off Big Fish Games for almost $1 billion in cash, you saw them effectively exit the casual gaming world and embark on the playbook that defines the company today, with historical racing machines being a huge part of that. And so, kicking off that transition was the launch of the Derby City gaming facility in Louisville, which opened in September 2018 with 900 HRMs at about $65 million cost to build. And we've since seen the company's total number of HRMs grow from 1,000 in 2020 to 3,000 in 2021 to almost 7,000 in 2022, and now more than 10,000 as of 2024. And so we talked about this already, but just to say it again, HRMs are legally tied to historical horse races, not standard slot machines, meaning they sit under horse racing statutes rather than full casino regulatory regimes. And here, I think one of the key pieces of jargon to know is referred to as the win per unit per day, meaning what is the average revenue earned per machine per day over a certain time period. And so, for example, if we look across the company's portfolio of historical racing machines at venues across the country, we see different levels of productivity. In their Richmond location for HRM betting, the win per unit per day comes out to about $470 over the 12 months ending on October 31st, 2025, meaning each HRM at the Richmond location generated about $470 of house win per day. And that house win number is calculated roughly as total HRM gaming revenue per machine per day after accounting for payouts to players. And so it's more of a net revenue number. And since we know that this venue has 1,200 HRMs, we can actually figure out about how much total revenue this venue generates. And it's about $200 million annually. And these rates of profitability per machine, you might say, can vary a lot just across a single state. And their new location in Northern Virginia, the daily revenue per machine net of winning payouts is only $230 on 1,650 machines. So that's something like $130 million in annual net revenue. And you would expect Northern Virginia, right outside of DC, you would think that would be one of the best markets for the company from a unit economics perspective. That doesn't actually end up being true because these more affluent areas also have more entertainment substitutes and potentially more regulatory scrutiny and community pushback. Plus, there's simply just more machines at this venue. So the usage per machine is lower than in markets where a Churchill Downs venue is the only place to gamble for 100 miles. And you have subtle things like one venue being closer to a state that doesn't permit this type of gambling. That can mean much more local traffic plus out of state traffic coming in too. And so even though some venues can be twice as profitable per machine, if not more so than other venues, not every venue can house the same number of machines. So their impact on the overall financials varies significantly. And even the most profitable venue, which is actually their newest in Henrico County, Virginia, generates more wins per unit per day for Churchill Downs. That only goes so far if the venue has a fraction of as many HRMs as other venues. And one of the most important things about these HRM venues, beyond their contributions to Churchill Downs for revenue, is that they're used in part to contribute to the purse at their corresponding racetracks. And purse, for context, is the payout to winning horses at live races. So more betting on anonymous historical races via HRMs funnels more funds into the winnings at live horse races, which attracts higher quality horses and jockeys, producing a better racing product that just spins the flywheel of their competitive advantages. And if you don't have successful HRM supporting your racetrack, it's just a lot harder to pay out enough to attract top tier talent. And without top tier talent, you'll never have the prestige necessary to run a profitable horse racing and gambling business. And that's one of those things that, as an outside observer, would not be obvious. And as you start to dig in and peel back the onion, you see, oh, okay, this is what really positions Churchill Downs to maybe not have a huge moat, but definitely to have some meaningful competitive advantages that make it challenging for new entrants.
It's very interesting. And as most listeners will probably know, it's very hard for us to find a company and cover it and not talk about any sort of flywheel. Because if it doesn't have any, it's probably not high quality enough to make it onto the show anyway. So there it is. And I think it's fair to say then that Churchill Downs very much does have some competitive advantages compared to, as I said before, most other casino or just gambling businesses. And it comes from their IP and their brand power that helps just attract more consumer attention and top horses to their regulatory relationships, which is an important point as well, maybe one of the most important in the entire industry. And states are typically only willing to approve so many racetracks, casinos, HRMs, and so on, as I understand it. And so, by being something of a proven and just a trusted operator and having existing licenses, that is somewhat of a barrier to entry relative to competition or competition that could potentially come up in the years ahead. So, there are actually only a few states that permit HRMs generally, and those are Wyoming, Virginia, Kentucky, Alabama, and New Hampshire, right? Those are the only ones.
They are, and yeah, when I was talking about the different venues before, I think I mentioned 3 separate Virginia locations, and so it's natural to wonder why the business is so concentrated in Virginia, and I'll just say it is. Kentucky, Virginia, and then to a much lesser extent, New Hampshire are really the 3 states that they operate these HRMs out of, and for context, Kansas has authorized it, but we're still waiting for the first machines there to really go into effect. And then other states have tried to authorize HRMs, but ran into legal obstacles. So Louisiana lawmakers voted to allow HRMs back in 2021, but then the law was struck down by the state Supreme Court, and something similar happened in Oregon. So on the one hand, the HRM business here doesn't really feel like it's on the firmest ground, since even in Kentucky and Virginia, Churchill Downs has only been operating HRMs there for a few years. But also, there is just massive potential for entering new markets if new states approve HRMs in the future. And so, for a company with a less than $8 billion market cap, operating their historical racing machines primarily out of really 2 states at the moment. I mean, technically 3. Just intuitively, even an additional 1 or 2 states entering the market could be really material for the business. And none of those states have the history of horse racing that Virginia and Kentucky do. So, those are really the 2 best markets for them, and none are going to move the needle as much. But still, I mean, the point remains there's a lot. There's 48 other states for them to be looking at. And so a lot of states, though, see HRMs as slot machines in disguise. And so they're not too keen on them, but the ones that do approve them spin it as sort of a different form of pari-mutuel wagering on racing, which is a lot more palatable than just saying slot machines, and then tends to have more favorable local laws regulating it. And so pari-mutuel wagering, for context, is a system where bettors wage against each other, not against the house, like when you're betting through a bookmaker. And so all bets of a specific type are gathered into this common pool of money. And before the winners are paid, the racetrack removes a portion of this pool as the takeout. And so, takeout, in essence, is just the price of betting on a sporting event. It's the percentage of every dollar wagered that's extracted before the winnings are calculated. And so, basically, in other words, the money generated by takeout is used in part to pay taxes and fund the sport. And the remaining money from the pot of wagers is then divided among all the people who placed a winning bet, proportional to their wager amount. That's pari-mutuel wagering in a nutshell, in contrast to HRMs, which again are more like slot machines. And so that is everybody's gambling lesson for the day. And if you don't participate in this stuff, I'll be the first to say it is confusing.
It is complex, but I also think it's pretty interesting to just get somewhat of an idea of how it works, even if I think most of our listeners, just as the two of us, would probably not spend too much time in casinos in their normal weeks. But I still don't fully understand, or maybe you can tell me why Churchill Downs still is so concentrated with their HRMs in just those 3 states, because technically they could also be expanding into Alabama and Wyoming and even Kansas soon. And if the thesis is in part that they could go to these 48 states that they're currently not yet in, why are they not using the states that they could get in today?
Well, that's a really good question. And, to be clear, Churchill Downs does operate or have stakes in casinos and gaming venues across actually 11 states overall. But yeah, specifically for HRMs, their focus is narrower. And that is primarily because in those other places, there are local competitors that have come to dominate the market. The taxes are just very prohibitive, or it's too difficult to find space and approval, not only for an HRM venue, but also for a new racetrack for it to be bolted onto, which is usually required. And so in some places like Wyoming, for example, they would be encroaching on local historical horse racing players like Wyoming Downs, as well as local commercial and tribal casinos. So that gets messy. And that's how you get a strategy where they prefer to focus on areas where they've gotten the green light approvals already very clearly. And so, in fact, they have found that it's actually more profitable for them to just concentrate on a specific state, build up the local culture around HRM gaming there, and go from there. And it's kind of like maybe the way I would think of it is like how Uber started by scaling one city at a time. When you're trying to get people to adopt something new, a much more localized approach can make a ton of sense in the beginning. You can't expand into every city at once. If you go one by one, it's very pragmatic. And so I also say that management has told investors that their HRM facilities target a 5-year payback period, and they have generally beaten that. So there are very attractive returns on incremental capital to be earned in these regulated niches, even if so much of the business seems to be concentrated in really just 2 states because they're just starting to grow their presence in New Hampshire, and New Hampshire is a much smaller state than Virginia and Kentucky anyways.
To stay with the Uber reference, I think what I would consider a possible risk is that Uber once planned on also growing in international markets that they currently are not operating in anymore and just bought stakes in other companies. And I'm asking myself if this is what it could end up being for Churchill Downs, where they think, okay, this is a market that we potentially get in a couple of years. And then they realize there are competitors already that are so entrenched that they cannot get into this market. And there's only so much market left in the current states that they're operating. So I think that's something that would probably be relatively interesting to look at. But another thing is just horse racing in general as a sport. How is it doing? Because I know that the Kentucky Derby is doing very well, but it's also a special case that's not entirely representative of the rest of the industry, I would think. And is horse racing and the gaming surrounding it growing, or is Churchill Downs just trapped in this relatively stagnating industry, especially as other forms of gambling have become incredibly popular over the last few years? I mean, just a decade ago, you couldn't really legally bet on sports at all in the US, at least in most places. And yet now you told me that it feels like everyone is just walking around on their phones looking for prop bets and parlays to roll the dice on.
It's a fact. I know too many people that are hooked to those apps, but yeah, I mean, more people in the US are gambling than ever. But as that pie has grown, so have the different ways to bet. Meaning, not only is Churchill Downs competing against things like poker and mobile gaming and fantasy football, they're really going up against any form of addictive entertainment that people might choose to indulge in. Scrolling TikTok is also an addictive habit. And if someone's hooked on that, maybe they aren't going to go down to the tracks to bet on horse races and use HRMs. And so I see Churchill Downs as having 3 buckets of risks. You've got the popularity of horse racing itself as one bucket, regulators, and then the company's own levered balance sheet. And so, in terms of the sport of horse racing, in 2024, there are only 31,000 thoroughbred races run in the US. And I actually thought that sounded like a lot when I first heard it, but the number is down 3% from 2023. So the number of race days in fields has shrunk. And correspondingly, the amount of total betting in industry wide parimutuel handles has fallen for 3 straight years, despite the overall growth in sports betting we've discussed. So this does really look like an industry in modest decline. And in part, the pivot toward HRMs and regional casinos, I would think, is meant to address this weakness in live horse racing. But there are very much secular headwinds facing the sport that the market finds concerning. And so in 2023, Churchill Downs also experienced a cluster of horse fatalities that did not help at all with their public image. They gave animal welfare groups a lot of ammo to frame horse racing as animal abuse. And we are not here to agree or disagree with that. But I think the future of horse racing is not incredibly bright. And if the sport itself is in decline, then that would eventually erode away at the Kentucky Derby. even if the event is so popular that it remains somewhat insulated for a period of time. You can't remain, at the cultural center in the way that it is of being able to command the viewership that it does in a sport that is, kind of fading from the inside out. And so adding to the risk profile here, you've got this concentration in just a single event, concentration in a single sport, and concentration of their HRMs and casinos in just a few states on top of a not so conservative financial risk profile either. And I would say that owning a stock like that is not for the faint of heart. But between the Derby as this really durable trophy assets and the growth in HRMs, hopefully you can start to see what I find appealing here when we're talking about a company trading at 21 times earnings. It's about two-thirds of the S&P 500's PE, despite a 5-year average revenue growth rate of 20% per year, which is much, much faster than the S&P 500's growth overall.
That definitely looks attractive at first glance. So, okay, I did want to ask you about that to some extent, because we've talked about the sport of horse racing and regulations through the lens of, let's say, risk management. Financially, I actually see a stable record of dividends and buybacks, but there's also a ton of debt here. So, how do you think about the financial soundness of Churchill Downs overall?
I would not say it's the most inspiring set of finances we've ever looked at on this show. It reminds me of Smith& Wesson, which is a company we did end up passing on due to balance sheet concerns. S&P recently lowered its credit rating on Churchill Downs to double B minus from double B in October 2025, which is considered a non-investment grade rating, but not quite junk status due to slower than anticipated debt reduction and leverage remaining about 4 times. So the credit rating agencies continue to see some concerns here. The company's current ratio of 0.57 is well below 1, which usually indicates that a business does not have enough liquid current assets to cover its current liabilities, bills that it's got to pay in the next year. And so, in other words, there's just not enough cash at the moment to pay the bills coming due soon. And that sounds really bad as I'm saying it out loud, but I really should clarify that that does not mean they will go bankrupt by any means, because a lot of that is deferred revenue and accrued gambling payouts, which are held in restricted cash reserves and funded by float. But still, there is not a ton of room for error because they do carry such a significant amount of debt structurally. And they spit off a lot of cash. Business is profitable. They have untapped credit facilities if they need to. So, like I said, this is not a company where I'm sitting here going, they actually could go bankrupt, which is something we talked about with Smith& Wesson. What puzzles me a bit, though, is how committed management has been to returning capital through annual dividends, with 15 consecutive years of dividend increases and fairly aggressive share repurchases of over $2.1 billion since 2025, where these are largely being financed using debt. And so management, in a way, then is making a leverage bet on future expected cash flow growth that can make these buybacks more accretive in hindsight and improve the company's leverage ratio over the long term. And whether you agree with it or not, and I wouldn't necessarily say I do, the result has been that they've created some very impressive amount of shareholder value by keeping the business so leveraged. And for years now, Churchill Downs' stock has outperformed the S&P 500 by a wide margin.
I mean, just from what you told me now, it does seem like a pretty risky strategy, but I probably have just too little insight to actually judge the strategy. I mean, we looked at TransDigm a while back, and that is obviously a completely different business model, but it might also be the most leveraged company we hold in our portfolio currently. And the difference there is that you have highly recurring cash flows, huge industry tailwinds, and I think a 3-decade long history of that strategy working out. So in this case, I would be much less certain. But again, I haven't looked at the financials to the extent that you have. And there are more bright spots about the business that might help to balance out those financial concerns. I mean, one of them would be TwinSpires Gaming, which is a third business unit besides the Kentucky Derby and then HRM. So what exactly is this part of the business and what should we know about it?
Well, we've implicitly touched on TwinSpires a few times, but it is worth spelling out what this business actually is. And this is a part of Churchill Downs that actually once tried to play the DraftKings and FanDuel game as a national online sports book. They hated the economics, and then they refocused the business on what they're really good at, which is horse race wagering and the rails behind that business. And so inside of this segment, there are really two pieces. There's a B2C side, which is the Twin Spires horse racing app and website that regular customers use. And then there's a B2B side where Churchill provides the betting infrastructure for other sports books, horse racing products. And that's why it can be a little confusing to talk about Twin Spires. It is more like a bundle of related businesses that all get reported as one line item. And on the consumer side, Twin Spires Horse Racing is one of the largest, according to the company, most profitable legal online horse racing platforms in the US, even though it never became a broad national sports book. And with that scale, they're offering 24/7, 365 days a year wagering on roughly 165,000 races globally at around 360 racetracks. And on the B2B side, Twin Spires gets paid by other sports books to power their horse racing offerings, providing the racing data and the live video and the handicapping tools, and in some cases, the underlying wagering platform itself to those businesses. And as a customer, if you're using Twin Spires directly, it works just like a standard advanced deposit wagering platform or ADW. And you fund an account and then you bet on domestic and international races while watching the live video feeds, not just at Churchill Downs' own tracks, but across a big network of partner racetracks as well. And it's pretty staggering. But management has said Twin Spires has at times controlled close to half of online horse race wagering in the US. So even though total horse wagering has been flat to down in the US and Europe, the online slice of that pie has been growing over the last 5 or so years. And Twin Spires is taking a big share of that shift. And industry members suggest online horse race handles in the US has moved from the mid single digit billions annually to the high single digit billions. And Twin Spires itself is processing something on the order of a couple $1 billion of that each year.
Before we get into the valuation, and we to some extent are kind of there, I do want to talk about how Churchill Downs differs from and to some extent is similar to other gambling companies. So listeners have probably heard of businesses like DraftKings, which we mentioned in this episode a couple of times, or Flutter, which owns FanDuel, and Penn Entertainment. And my question is, why not pitch them instead? I mean, if they're more diversified in the sense of the sports they're tied to than Churchill Downs, you could argue that's an advantage that apparently, from what you told me today, Churchill Downs would probably never have.
So this is going to be a really silly answer from me, but I do have this bias where I don't know if I see horse racing to be as bad for society from a gambling perspective in a way as these broader sports books where you can literally bet on a different game every day across dozens of sports and parlays. And it's a lot of nonsense, in my opinion. And I'm not saying at all that's the right way to think about it, but I've probably been pretty hesitant personally to cover these other companies where it doesn't feel like they're creating win-wins for society. Because to me, that makes me feel like long term their businesses are fragile, which is not to say anything about Churchill Downs in this case. When we think about Uber, they got a lot of criticism for, people didn't like that it disrupted the taxi industry. People didn't like that Airbnb disrupted local neighborhoods. But at the end of the day, the benefits and the convenience that those apps could provide outweighed the negative voices. And when I think about, like I said, these broader national sports books, I think they're really popular right now. I'm not sure if society will have the same tolerance for them forever, but that's just totally speculation. And maybe I'm falling for the marketing too much, but I do think the Kentucky Derby itself is something of a special asset that almost transcends gambling. The experience is unique, and what originally drew me to looking at Churchill Downs in particular was wondering whether there was some sort of trapped value here, especially when we're talking about a hospitality business that can sell suites for $250,000. That's why I say it transcends gambling in a way. I mean, that is a masterclass on hospitality. And, we talk about conglomerate discounts sometimes. And that's because promising businesses or assets can get buried and overlooked in these sprawling companies. And Churchill Downs is a bit sprawling, even if it's not a huge market cap. And so Yeah, I'll have more to say on that when we get to talking about the valuation, but the intention was to try and determine whether the Kentucky Derby itself is undervalued and whether any value could be unlocked and with some kind of catalyst like a spinoff or a take private.
I think I have a slightly different take on horse racing. I mean, this is really just my gut feeling, but when I think about it, in my mind, it's basically immediately going to gambling addiction rather than the sport itself. That's obviously a bit unfair, especially when you think about something like the Kentucky Derby, which is this huge and just culturally important event. But it just feels like the share of people who watch horse racing and bet on it is much higher than in almost any other sport I can think of. But again, this is purely my perception. It might be very different in countries where horse racing is more of a mainstream sport in its own right. So, yeah, getting back to just the topic of competition and the companies that we talked about earlier, I do still want to hear how Churchill Downs stacks up against these other publicly traded gambling companies, not only looking at it as a more moral way of gambling.
So the landscape here is Churchill Downs, Penn, MGM, Flutter, DraftKings, and Caesars. And when you look at them, minus Flutter and DraftKings, these are asset heavy businesses that are as much about in person experiences and hospitality as they are about online gambling. And so Penn Entertainment alone, for example, operates more than 40 casinos in the US. And well, casinos require a lot of capital compared to these app-based platforms like DraftKings, which is just purely a digital business. And so there's no real estate for DraftKings. It's an app, and to a lesser extent, you could say that about Flutter as well, with FanDuel. But they do have some retail shops. But just to maybe zoom out a bit, there are roughly 1,000 commercial and tribal casinos in the US, serving a total population of 340 million people. If you compare that with the 30 casinos in Macau, China, serving, 1.4 billion Chinese people, or the twin casinos in Singapore serving a population of 6 million, you can actually see why these Asian casino businesses tend to be much more profitable and better businesses to own. And so, the difference is that the US tends to be looser with casino regulation by global standards. And that actually means that there's more competition here, which reduces the moats of US based casino companies relative to their peers in Asia. And today, more than 40 US states offer commercial and or tribal gaming, with many legalizing wagering activities just in the last 2 decades. And but legal gaming itself in the US goes back almost a century to when gaming was first legalized in Las Vegas back in 1931. And it was not until 1976, though, that Atlantic City allowed gaming too. And that offered really the first real competitive option in the US as an alternative to Vegas. And then after that, it wasn't until the 90s that you saw several more states begin to legalize gambling and enabling more competition. And since then, we've seen things really heat up online and with physical casinos.
I know that I've teased the evaluation section now twice, but if we can just go on one more tangent before we get to the valuation, can you speak more about the quality of management here and the compensation as well? Because whenever we are sort of iffy on a company, how aligned the management comp is, shareholders can either be the deal breaker or it could help a lot with just trusting the company and the story that you want to tell to investors.
For starters at the top, Bill Karsanjian has been CEO since August 2014 after previously serving in various C-level roles at the company since 2005. And so I would say he has pretty substantial skin in the game with about $190 million worth of stock personally in the business. And then there's Bill Mudd, who has been president and COO since September 2015 after joining Churchill Downs as CFO back in 2007. And Mudd also has significant skin in the game with $80 million of stock as of when I last checked. And um, CFO Marcia Dahl, who's been around since 2015, also owns about $17 million of stock. So that's all great to see. And I think even better is that these three have overseen very excellent returns for shareholders in their time. And from what I can tell, they didn't do that just simply by riding a wave of popularity in sports betting. I mean, instead, management has proven adept at acquiring and divesting assets opportunistically, expending capital on new build projects that oftentimes very short payback periods and then buying back shares. And so management has remained really incredibly long term focused. And one of the things that they do to signal is that they don't provide quarterly or annual guidance, which is also something that Berkshire Hathaway does. And so it's just one of those subtle things where it shows you how seriously a management team lives by their words, right? You can talk all day about the long term, but then you're giving guidance on the next quarter. It just seems contradictory. And Buffett, of course, famously does not give any guidance. And another thing I've heard about the company's management team is that they are real masters of the legislative process. They come in to lobby states as the owners of the Kentucky Derby, not just some other greedy group out of Las Vegas. And then that means that doors can open for Churchill Downs that do not open for others. And in terms of how well aligned the comp packages are, it's mixed. A lot of the long term comp is based on performance and paid in equity, but the performance metrics lean into more manipulatable non-GAAP numbers like adjusted EBITDA and not returns on capital or earnings per share. And gosh, I feel like we complain about that in just about every pitch now on the show, but a chunk of that comp is in RSUs, restricted stock units. So that means the comp is unlocked simply for just sticking with the company over a period of time. And I have been known to call that something of a participation trophy as opposed to, a real incentive package based on performance. And anyways, the long and short of it is I do like the management team. I think the comp could be better aligned with long-term shareholders, but also the track record has been very good. So who am I to argue against it? That's just my 2 cents.
I mean, just from the insights that I got from your pitch day, it seems to me like the management has had a pretty good feel for how to maneuver a gambling business through both competition and also regulation. So that's definitely a positive thing. And if you compare that or just add to that the skin of the game, I think I can look beyond the RSUs and call it decent overall, but probably also not enough to remove some of the doubt about financials, regulation, and all of that, which basically comes from this just very complex business model. Anyway, let's finally do it. I tease it a lot, so let's talk valuation. I mean, so far, I would say this has been, as you said, pretty mixed thesis. Certainly interesting, but yeah, I don't know. I'm hoping you can blow me away with how to think about the business and why it could be an attractive investment. Yeah.
Well, if you think about it in sports terms, we've seen private equity lining up to pay these eye-watering prices for slices of NFL teams, NBA teams, sometimes 30 plus times EBITDA in some cases for private illiquid franchises where EBITDA is this kind of rough proxy for operating profits. And so Churchill Downs, by contrast, owns what is basically a publicly traded Super Bowl week in Louisville. And then the market is valuing that crown jewel implicitly at a fraction of those other multiples. And the thing is, sometimes the market will give you great chances to snap up this business due to things that really have nothing to do with its long-term viability. And so, for example, on May 3rd, 2025, the Kentucky Derby took place in Louisville with its typical pageantry. But unfortunately for Churchill Downs, the race day had inclement weather and there's rain throughout the day that created muddy racing conditions for the horses, which also just hurt the company's financial results as well as betting handle and attendance overall. And that hurt ticket sales and concession revenues and all that stuff. And so a weak Derby result is disappointing and it can drive these really sizable sell-offs in the stock. Yet I would contend that the performance of a single Derby, especially one mired by bad weather, I mean, this is very little about the business's long-term prospects. And so you'd expect that to almost already be factored into how the market values the stock, that there is the possibility of these events. So then why would, a one-off rainy day cause such a significant move in shares? And so you have to know getting into this thing that the business is not always going up in a straight line, despite this record of compounding. It is also not entirely a cyclical business either, but I mean, you can definitely imagine much steadier businesses to own at the same time. And so as I said, every so often you'll get a derby where the weather is just awful or a renovation temporarily takes some seating offline or maybe corporate budgets kind of tighten right in the middle of peak booking season. And that can knock a few million off the derby's profits. And then suddenly investors start asking whether the party's over and the shares crash. And my view is that most of those hits to the profit and loss statement are cyclical and idiosyncratic, and the asset itself, as a 150-year-old brand, is not going anywhere. I could spin a story about how horse racing as an industry is in modest decline, but I mean, just to be real, for any foreseeable period of time in the future, I don't see the Kentucky Derby waning in relevance. I mean, like we said, it's continued to attract more and more viewership and impressions on social media and Netflix documentaries. It's really as popular as it's ever been, and yet at the same time, from nothing, they've grown historical horse racing into this large, profitable chunk of the business. And really, I would say they've only just begun to tap into the potential addressable market for that business, right? We talked about how the HRMs could go into probably not all 50 states, maybe not even 10 states, but even just 2 or 3 more states would be a huge expansion opportunity for them. And if you strip Churchill into pieces on a back of the envelope basis and give the historical horse racing and regional casinos the kind of multiple that you might expect from just a decent regional operator, and then you value TwinSpire as more like kind of a high margin but slow growth wagering platform, well, then what's left over, the implied multiple for the Kentucky Derby, I mean, it's pretty shockingly low. I mean, you're effectively getting one of the world's most recognizable sporting events at a single digit multiple of operating profits. Well, again, private investors are paying nosebleed prices for franchises that I would say are honestly far less iconic than the Kentucky Derby.
More international, but definitely far less iconic. That's true. And I mean, gosh, it keeps just being this mixed picture. I mean, the valuation certainly seems interesting, but there are just so many factors that just add more and more complexity to it.
What I also like here, though, is how the capital allocation behavior lines up with the thesis, right? When investors freak out because one derby is softer than expected and the stock trades down, management has weathered many of these storms and does not panic. And so in the past, what they'll do is they'll slow walk big projects, they'll reassess them and their viability under these new macroeconomic conditions, and then in the meantime, they'll buy back big chunks of the company at what I would say amounts to, significant discounts where you're getting a single digit multiple on the Derby's operating profits. And so management is essentially telling you, if you don't want this at this price, we will happily take it off your hands. And I think that's great to see. And in Q2, for example, when the stock was depressed after a relatively weak Derby in 2025, they repurchased 3.5% of all outstanding shares for $250 million. And, you know, with all that said, it is not a stock that looks as obviously cheap at today's prices as it was even just a few months ago when the market was still reacting to how the weather had affected this previous derby. So, given all the risks here and really my lack of experience with this industry, I'm not keen to say we have to invest in it right now, but I would love to keep it on the watch list. And if we can snap up shares down the road, especially if there's another derby disappointment, man, I would be inclined to do so. And it would be one of the higher risk bets we've made, and we'd have to size it proportionately. And there's a lot of ifs being baked into it. But yeah, that's how I think about it personally.
It's a cool asset to own. I mean, to me, this just seems like a relatively clear case for the too hot bucket. But then again, it's also different if you're from the US and you just get this whole idea of just what a cultural experience it is in the entire country for those, let's say, 1 or 2 weeks that it's happening. And I just can't have the same idea of the cultural relevance of the event. Since I've never heard of it before, you decided to pitch it today. And then you have all the regulation that comes with it, and then just the gambling itself, and then the debt profile of the company. So this opportunity would just need to be outrageously attractive. And what I mean by that is basically saying it would need to be much cheaper for me to look past those factors and then accept that I have just very little and basically no unique insight into the business.
Yeah, I think that's totally fair. I think that's totally fair. Well, cool. It's been fun. I mean, with everything we've covered today on Churchill Downs, maybe we just transition things and go to a little preview of your pitch for next week, Daniel.
Yeah, I must say it's probably not as exciting as this one. I felt like I've learned so much in this pitch, and Next week, we will cover a company that is undoubtedly known by everyone listening to this episode right now. It has been under a bit of pressure recently, and it is probably the go-to example when you want to make an argument against efficient markets, because a couple of years ago, it has, despite its massive scale, been just outrageously mispriced and almost turned into a 10-bagger in the years after that. I think it only took the stock 2 or 3 years. And yeah, today it's trading again at a low valuation, although to be fair, nowhere near the levels of the past. So yeah, I don't know. It feels like every other hint would immediately give it away. So I think I'll leave it at that.
Maybe just to help the audience a little bit, I'll say that the stock looked cheapest in 2022.
Yep,
we'll
that's
leave,
true.
we'll leave it there. Cool. Well, all right, folks. I mean, let's go ahead and wrap things up with a little quote today. And so John Steinbeck once said, "The profession of book writing makes horse racing seem like a solid, stable business." And I think you could say the same for investing. We'll see you all next week.
Thanks for listening to TIP. Follow the Intrinsic Value podcast on your favorite podcast app and visit theinvestorspodcast.com for show notes and educational resources. This podcast is for informational and entertainment purposes only and does not provide financial, investment, tax, or legal advice. The content is impersonal and does not consider your objectives, financial situation, or needs. Investing involves risk, including possible loss of principal, and past performance is not a guarantee of future results. Listeners should do their own research and consult a qualified professional before making any financial decisions. Nothing on this show is a recommendation or solicitation to buy or sell any security or other financial product. Hosts, guests, and the Investors Podcast Network may hold positions in securities discussed and may change those positions at any time without notice. References to any third-party products, services, or advertisers do not constitute endorsements, and the Investors Podcast Network is not responsible for any claims made by them. Copyright by the Investors Podcast Network. All rights reserved.
Manchester United is among the biggest brands in the world. Forbes values the club at $6.6 billion, but you can buy its shares at a market cap of just $2.7 billion.
Forbes valuations are pretty on point historically. And with Chelsea selling for over $5 billion, United should not struggle to sell at Forbes' $6.6 billion valuation.
The question, though, is whether the Glazer family actually wants to sell, and if not, what else can boost the stock price? Perhaps it's a new stadium, although it sounds pretty unlikely, but that could be a good reason for the stock going up significantly.